Hello everyone, I'm Shevik with WESPAC. We are a 401k provider in the Charles Schwab Retirement Network. You can find more information on us specifically in the link below, but in this video I'm just going to briefly cover the basics on what to look for and how to compare providers for those of you who are looking to either set up a new plan and could use a starting point, or for plan sponsors who are looking to do their due diligence in comparing their current provider, and of course where WESPAC can fit into the picture. As is usually the case, you probably won't find a provider that satisfies all of your needs while being the cheapest option. Instead, there are trade-offs, and you'll have to consider what you are giving up in order to pay less, or what do you not value that you are paying for. For example, maybe you are paying for financial advice when you and none of your participants need or want to see your advisor, or you may be paying very little, but you are taking on more liability in the process than you are aware of or comfortable with. The idea here is to best match the services offered with the goals of your plan, whether those goals are to provide the most value to your employees, or to pay the least amount as a company possible, or to maximize your personal and corporate tax deductions. Once you know what you are trying to optimize for, you can much more easily choose a provider.
There are plenty of providers out there, but the landscape is quickly changing. In fact, since 2009, we've seen, on average, a reduction of 30% in prices charged. Much of this is due to technological advances such as automation that are reducing costs. Technology is also allowing advisors to better reach participants, to give more and better information, and to offer calculators, and also offer a better platform for participants to see their balances and have more control over their investments. And although the Trump administration has pushed back a bit on this, the overall trend is clearly toward higher fiduciary standards. More regulation is coming out that advisors have to stay on top of. All this spells out consolidation as advisors who can't keep up are shaken out of the marketplace.
Now, you may be completely happy and confident with your current provider, but it would still be prudent of you as the fiduciary of your plan to occasionally run up benchmarking. This means you compare your current costs and services to the marketplace. This way, even if you don't plan on changing providers, you can always say you've made an informed decision on behalf of your participants. Making sure the participants are not overpaying is the simplest way to reduce your liability. ERISA doesn't really care if you as the company are overpaying, although you might. Also, even if they are doing a good job, I guarantee once you request this information, your current provider will treat you even better.
Now there's much more to consider, and you can check the other videos for a more comprehensive overview, but for the sake of being brief, I've boiled this down to just 3 considerations mostly. Are you satisfied with the overall level of communication and administrative load on your end in the plan? Also, what level of interaction do you want with your advisor? Maybe your employees are already familiar with 401ks and are confident with their investing, and they don't need or want to see someone like me. But where we add value is that our clients want someone to come out and discuss the plan. At the end of the day, one of the advantages of having a 401k is that it's an asset to your employees and makes you as an employer more competitive in hiring. And having a third party come out and first off tell them the value of having a 401k plan, the importance of investing for retirement, and the significance of any contribution made from the employer that can make on the outcome of their retirement are all things that emphasize the value and quality of the plan, i.e., the material benefits of being employed by you. There's also liability to consider. We typically act as the 338 fiduciary, meaning we have discretionary control over the assets, so we take on the most responsibility possible in selecting and monitoring the investments within the lineup and educating the employees. And as healthcare is consuming more and more of the HR department's time, it's especially the case that we find sponsors usually prefer to outsource these tasks and mitigate their liability, so that you don't have to worry about information ratios, offering advice and education, creating their own legal documents, or monitoring their investment lineup. Some clients, however clearly the minority, prefer we act as the 321 fiduciary. Typically, these are much larger clients, those with greater than $15 million in assets. They're usually less worried about liability and more wanting a seat at the table for making important decisions on behalf of their participants. Now, even with a 338 fiduciary, you'll never absolve yourself completely of liability, but you can think of a 338 as a defendant and a 321 fiduciary as a co-defendant should a litigious scenario arise. And then there are also 316 fiduciaries, which has to do with administrative liability. And although we are also the TPA, we don't advertise ourselves as this type of fiduciary. It's newer to the scene, and the responsibilities are less defined, which means there's less protection on your end. So when working with us, our tasks and responsibilities are specifically delegated through our service agreement. We find that to be a more sound way of offering protection. And then, of course, there are those who are not considered fiduciaries and don't offer protection. You can think of these as more integrated providers who may only provide a platform, and then it's up to you as a sponsor to make sure everything is done correctly and is compliant. Now, I'm not saying this is necessarily a bad thing. Plenty of smaller employers do prefer to do things themselves. So just make sure that your expectations and goals line up with the provider that you choose. As I mentioned before, the costs should be straightforward, but usually aren't, and there's a lot to consider. First off, you have to separate the plan costs from the investment costs. The plan costs are typically the record keeping and administration fees. Those costs can be deducted from the company taxes, while the investment costs, which are the advisory fees and expense ratios of the investment offerings, are not tax deductible on the plan or participant level. There can also be transaction fees, front-end and back-end loads, and these costs are also not tax deductible. So when you see a very inexpensive plan from the employer's point of view, that usually means it may be expensive from the investor's point of view. And maybe that's what you want. If you want to check off a box for having a 401k plan and pay as little as possible, that's definitely one way to do it. But if you want to add value for your employees, or if you yourself have a large balance in the plan, it may make more sense to pay less as an investor and more as a sponsor. Also, as your company grows, if you plan on hiring more employees or growing the plan assets, then the investment costs will grow much more quickly than the plan costs. There's also something called revenue sharing to consider, which is a bit trickier. It may not be a direct cost to you, but it is an opportunity cost. This is basically what the investment companies kick back for using their product. Some providers may keep this amount or some part of it. We refund this back to you 100% to offset the plan fees. There's a conflict of interest of any provider who keeps this amount that you have to consider. Is your provider choosing investments because they are the best available, or is it because those investments are paying your advisor the most money to use them? That's just something you should be aware of or look into, and it should be disclosed on something called your 408B2 notice that should be distributed to you once a year. So if you are looking to compare your costs to other providers, there are 3 things you can request that will make the process much more comprehensive and simple. Those are the 408B2 notice, which is a sponsor-directed pricing notice of the overall plan costs, the 404A5, which is a participant-directed pricing notice, and the plan offerings, which should include the individual investment costs and any advisory or wrap fees thrown on top. If you can provide those to us, we can get you a very clear-cut and concise comparison. We also think that the fund selection is very important. One big advantage of the Charles Schwab platform is that it's open architecture. What that means is that you are not married to only Charles Schwab as a fund manager. You have access to many different fund managers and can pick and choose the best from each. Currently, we are big fans of American funds for their Target Date series. Vanguard, of course, has great low-cost passive options. We like some T. Rowe Price and Janus, and PIMCO has always had great fixed income funds. These are all options on the Charles Schwab platform. You can contrast this to providers such as J. Hancock, for example, who may only allow you to invest in J. Hancock funds and not their competitors. The Charles Schwab Bank platform currently costs $500 per year, and that gives you access to thousands of low-cost, institutional-grade share classes. And as the assets in the account grow, the lower cost funds are going to quickly save you more than that $500 charge. Now, being as a 401k plan is a pooled account, that gives you pricing leverage for access to lower cost institutional grade share classes that you wouldn't have in an individual brokerage account. Unless, of course, you had $1 million or so to meet the minimum funding requirements for those low-cost share classes. So the way we operate is that we offer a diversified fund menu that covers all the bases that participants can choose from. There are no transaction fees or front-end or back-end loads in this menu. Participants pay the expense ratio for the fund managers and an advisory fee. We select funds for a complete menu. So for the equity sleeves, international, domestic, different cap sizes, investment styles and sectors where appropriate, managed and index options where it makes sense, fixed income, and we like to offer a target date for a simple option that satisfies what's called the qualified default investment alternative, and capital preservation options for the risk-averse investors. The idea is to offer enough asset classes to take advantage of non-correlated assets, but not too many to overwhelm investors with choices. But you do have to ask yourself, can both a young, let's say 30-year-old aggressive investor and an older, more conservative participant who may be approaching retirement, can they both be satisfied with the investment options available? They're at very different points in their lives and will require very different financial solutions. That's what we mean by adequate selection. And lastly, we typically do like to give the option to opt out of our pre-selected menu and our advisory fees through something called a PCRA. This is a self-directed brokerage account, meaning you are not limited to our lineup and you can choose anything on the Schwab platform. This is typically reserved for more sophisticated investors who can buy, if they want to, individual stocks like Amazon, Tesla, ETFs like PowerShares, QQQ, mutual funds, bonds. Pretty much the financial world is your oyster in this account. And this might be important if you already have a financial advisor that you use. He or she can directly manage your PCRA. Or maybe you're a very fee-sensitive index investor. You can buy, let's say, the total stock market index or the S&P 500 for just 3 basis points with no transaction fees and no loads, which is basically the cheapest current option out there. And because you are choosing your own investments and waiving liability, our advisory fee is also waived. Now, the downside is people can potentially burn themselves by trading individual stocks without an advisor's supervision. So as a sponsor, it is entirely up to your discretion on whether participants are allowed to open the brokerage account, or perhaps you might just want to restrict these to the owners of the plan. Well, I hope you found this video useful. Again, this wasn't to convince you to hire us, but to give you some useful metrics and starting points and considerations. But of course, take that with a grain of salt and do your own due diligence. I have more informational articles and videos that go into more depth on each subject that you can check out. And if you would like a proposal or a planned comparison of fees and services, please contact me and I will get you that information. I'm always more than happy to drop by an office or to walk you through anything you may need. Appreciate you all watching this, and I wish you good luck on your search.